Well, everybody, thank you so much for joining us today. My name is Kevin Breitner, broker with RE/MAX Real Estate Center. Along with me today is Dion Mahadeo, RBC mortgage specialist, and Paul Silva, real estate lawyer, pre-construction investor, and specialist as well. Paul Silva of Rinaldi Silva LLP. I've known these two gentlemen for 8 years now, both working alongside doing things in the industry and the business. We've become good colleagues and friends as well. We're both, all three of us, I would say, are very, very knowledgeable in the resale side as well as the pre-construction side. And that's why we've come together today to talk to you, not only about buying your first home, but what the differences are between buying your first home if it's a pre-construction purchase versus a residential resale purchase. There are many differences. We're going to talk a little bit about how we can help guide and advise and consult you to make sure you're making the right decision for your personal life and choices, because we're all different. We're all going to want different things. If you're renting now versus living at home, that's going to make a difference in what you're wanting to do as we go out, depending on, there's no point in paying rent, I guess is what I'm saying, if you're going to be waiting on pre-construction. The equity that you'll build in the pre-construction purchase will pretty much be wiped out by the rent you're paying while you're waiting for it to be built. But anyways, we'll talk about that later. There's 3 different sections that we're going to be covering today. Dion's going to be talking about the money, the lending, and everything like that. Paul, obviously, with the legal side, and then myself with the property side of things. All right, so let's start off with resale. That seems to be the one that we all know about the most. It's the most common. People can get involved in something at 5% is your minimum purchase deposit. Sorry, right now, and again, I'm going to let Dion talk more about the finances and the numbers that way. But your financing and your numbers is always step one. Whenever we're getting ready to work with a new buyer, that is the first thing we always want to do, is to make sure they understand their financial situation and what makes sense for them, what they're going to be able to afford. We don't want to start looking at something that costs X and you then find out later that you can only afford Y, and now you've fallen in love with X. So step one is always figuring out our numbers. I'll let Dion talk again when he gets into that about what is needed and how that all breaks down, but that is always step one. Quickly with resale, you can get in for a minimum of 5% down, where with pre-construction, the way it works is for builders to start building, they need 15% deposit of the purchase price and 70% of their units sold until they can start building. So depending on where they are in their sales cycle, when they started and when their building is coming, could really determine if you're waiting 3 to 2 to a year. And then sometimes there's units right at the end that you can buy pre-construction and still move in 90 days at the very, very end of their sales cycle. So when we're looking with first-time home buyers, obviously, again, you're doing something for the very first time. It can be overwhelming and nerve-wracking to some, and even some find it fearful. And the fear just becomes, you don't know what you're doing. You don't know what to expect. The unknown is what gets us all. Whenever we're working with a new buyer, I always give the same example, and I'll share it with you now. If we were just to drop you in a big black room and tell you to go find the light switch, you'd have that same unnervousness, that same feeling of uncertainty. Where do I go? What do I do? Where do I even start? And again, it could be even overwhelming, and you might never get started. You might not take that first step. But if you're in that same black room and a voice comes over the loudspeaker saying, okay, take 10 steps forward, turn 90 degrees to your right, take another 10 steps, and the light switch is going to be right there. With step-by-step instruction, you've removed all the uncertainty, the unknown, and the fear by being involved with someone that can guide and advise you how to do something. Again, step by step. This is what's coming next. Be prepared for this. This is what we're going to be doing. Because it is a lot to take on, and there's so much that happens. We don't want to fill you all with everything at once, so we talk about it as we're going through the process. Again, folks, if you have any questions at all throughout this and you want us to clarify something or something comes to your mind, please throw it in the comment box and we'll make sure we get your questions answered as we're going along. We'd like this to be as interactive as possible. I definitely would much prefer us sitting in a room all having one big conversation instead of me just talking into a computer screen, that's for sure. So please engage if you can, and or if you have any questions, and we'll definitely make sure to get those answered for you. So our team here, we're with RE/MAX Real Estate Center. We specialize in pre-construction. We represent a developer right now on a project called Glendora Towns, but we represent buyers on many different projects across Halton, Hamilton, GTA, all around, as well as resale. We have a team of professionals that we work with in whatever purchase we're working with. Paul and Dion are obviously two members of our a team that we work very, very closely with. So it's having a team of professionals around us that allows us to make sure our buyers, our clients, are getting looked after from beginning to end, knowing that we don't have to worry that they're not getting exactly what they need. So I'm going to take a quick pause right here, and I'm going to turn it over to Dion, and I'm going to let you talk about the financing, what we need to do to get their money started, lending, and everything like that. So Dion, please go ahead.
Correct. Hello, good day, everyone. Yes, so I am a mortgage specialist with RBC Royal Bank, and as Kevin mentioned, we definitely partner together to help clients, whether it's their first time home buying or buying an investment property, primary residence, moving to the next place. We're there for you in terms of all of your home buying journey needs or investment property needs, whether it's pre-construction or resale investment. So a couple of things that I want to talk about this morning without getting too much into the weeds, but we can definitely open up for questions and I can help clarify anything. First off, yes, when you're buying a home, whether it's your first time or your repeat time, minimum down payment to purchase a home is 5% up to 500,000. So anything higher than that, you've got to put 10% of that difference. So for example, if you're buying something for $500,000, minimum down payment is 25,000. But if you're going to buy something for 600,000, you're going to need to put 10% on that extra 100,000. So now your minimum down payment is 35,000. So when you're putting minimum down, it is something called a default insured mortgage or a high ratio mortgage. So we have to get that approved through not only the bank, but the insurance company as well has to approve it. And so with that program, whenever you're buying this for your primary residence, you can go up to $1 million max purchase price. And again, the minimum down payment would be 5% on the first 5 and then 10% on the difference. So that, say on $1 million, the minimum down payment in that case would be 75,000. So from a down payment perspective, when you're buying your primary residence, that's what the insurance territory would be. In terms of down payment, if you're buying an investment property or you want to get out of the insurance scenario and don't want to pay that, obviously, the best thing is to stay to 20% or obviously more if you can. Minimum 20% then again avoids the insurance and a couple more options open up. So, it depends on where you are. If you're a client that's just starting to save now and you've got, 25,000, to get to, buy something for 500,000 to get to 20% is 100, it's going to be a long time to do that. And I think we're going to talk about that later in terms of renting versus buying and what you need to do. In the scenario of getting in, if we can qualify you right now to buy, it's better in that case to, get the insurance and do it that way. But if you've saved like $75,000 and you want to, avoid the insurance, and it might take you a few more months to get to 100, then it would be advisable to do that to avoid the insurance. So it really comes down to where you are in your savings process and saving up to buy the home. So that's the first thing to know is the down payment. A couple of the things that you need to know in that. You can look at your credit bureau yourself. There's lots of different companies out there that offer free credit score checks. Just so you know, if you're an RBC client right now, I can't speak for the other banks, but they might be similar. With RBC, you can actually check your credit score for free in online banking. So you just log in on your computer and just click check your credit score for free. Soft credit check doesn't affect it. What we're looking for is a credit score of at least 680 or higher generally. If there's multiple applicants, at least one of them should be 680 or higher. Makes things a lot easier, and we can stretch things in terms of affordability if we can have a credit score above that. So you can check that and kind of know where you are in terms of that process. And then there's 2 ratios that we look at when we figure out what we can pre-approve you for. And so one's called GDS, gross debt service. They'll get into the nitty-gritty of the calculation. It's just what is your housing cost going to be in relation to your income. So we look at your mortgage payment, property tax, condo fee, heat, condo fee applicable in that case, and then divide that by your income. So when we do that math, if you've got a good credit score, we can basically go now up to a 39% ratio. So that means that 39% of your income is going to go towards your housing. So if it's 39 or under, we're good to go. when we look at the TDS ratio, which is the GDS plus all your other debts, it's basically now I look at the future mortgage payment, property tax, heat, condo fee if applicable. We add in things like car loans, student loans, credit card payments, line of credits, any kind of debt that's on your bureau. I've got to take the monthly payments into account, divide that by your income. With that ratio, we should be no more than about 44%. If we can get that there or under, then that's how I kind of figure out what we can afford. Now, I don't know if anyone was read in the news, but CMHC a few weeks ago had implemented some changes. And so they're one of the insurance companies that's going to get you the mortgage insurance. And so they're the government arm, and they've said that we're going to tighten this up a bit starting July 1, so next week. And what they're going to do is they're going to drop it down from 39 and 44 down to 35 and 42. So what that means is it's going to be less affordability. So bear in mind, that's only one of them. There's two other private insurance companies out there. There's Genworth and Canada Guarantee. So whenever you're putting that minimum down payment, that's where we have to go to one of those three. So if we can't do it with CMHC because the ratios are going to be too high, we can go to the other two. Bear in mind now, the other two now, they know that they're in the driver's seat with that. So they're going to be a little bit more picky. They're going to want to see a nice, clean deal. They're not going to want to see a credit bureau that has a lot of issues. They may start being a little bit more choosy. So we want to make sure that either we get those guidelines within the 35-42 to go to CMHC, or it's a nice, clean deal with credit and we can go to 39-44 to Genworth or Canada Guarantee. So that's one important change that's going to take effect next week. So happy to answer any questions around how that process is going to work. But their whole point of doing this is that taxpayers, like all of us, are on the hook for this because they're insuring the mortgages, and that, you know, if somebody can't pay their mortgage, they're going to have to pay the bank back. So they don't want to start burdening all of us if people lose their jobs, especially during the pandemic, and can't afford to make these mortgage payments. So they want to make it a little bit tougher. So it's going to make it obviously tougher on the first-time home buyer. And so that's why we're here to help, clarify and talk about what things we can do to help you if you're in that position. In terms of buying, like for investment property, now won't apply because now you need 20% down payment. Either you're buying an investment property, a second home, cottage, whatever the case may be, you need 20% down payment usually at least. In those cases, we're not worrying about insurance. So everything I'm saying is still going to hold. We're pretty comfortable with doing 39% of your housing costs, as a max for your income, and then 44% for everything else. So when we look at those scenarios, it's just the bank approving it. And that's kind of where you want to be in terms of affordability. So that's where I come in to help you figure out those numbers and give you the advice and steer you in the right direction on what we can do there. When it comes to pre-construction, in that case, as Kevin had mentioned, in most cases, you need to put down a deposit of at least 15%. When it comes time when it's, the building is complete or the project's complete, we don't have to keep it at 15%. We could go lower or we could go higher. Really depends on where you are in your savings process as well. The good thing with RBC and what I can help you with pre-construction is we do have a pretty unique program where we're able to do everything up front. And so if I had a client today that was buying a pre-construction and we had to then go to CMHC, let's say, we submit that deal before July 1, I get it approved. It's going to be up under the old rules of 3944. And whenever it's ready, whether it's a year from now or 2 years from now, we don't have to requalify you under any new rules. It will always be the current rules. So that's a huge advantage in that I'll give you an approval up front. We don't need to worry about any rule changes or maybe you not qualifying later with a pre-construction. So pretty key there. I've had clients as well. We had them approved before the pandemic hit. They were employed, everything was great, and now unfortunately they're not working. Their business went under. Whatever the case may be, I had them approved prior. We're going to grant them that mortgage. They don't need to stress about not being able to close that pre-construction they bought 2 years ago. So it's a huge deal that, when clients we talk, they may not have thought it would make a difference. So we'll just wait till it's a few months to registration and we'll have no problem. This is where I impart that, if we're going to do a pre-construction now, it's best to get everything qualified up front. RBC will give you a firm approval. If you're in between jobs, you go self-employed, whatever the case may be, we're going to still grant you that mortgage. You're not going to need to stress about it. benefits. So a huge advantage when you're buying pre-construction properties. So as part of that process, like I said, we do everything up front. You make your deposits. I'll walk you through that process and make sure that you get approved up front.
Dion, can I get you to talk? Can I get you to talk about getting a pre-approval and as well as rates being guaranteed on a pre-construction or even on a resale? How does that all work for them?
Yep, no, good question. Yep, for sure. So that was another part I forgot to mention. So yeah, when it comes to pre-approving, so that process of pre-approving, looking at the down payment, the credit, and those ratios. So let's say everything works out for resale. We can hold rates for 4 months or 120 days. And, if I pre-approve somebody and I start an application today, we'd be good till about October the 26th. So you have between now and then, if rates were to go up, I've got you locked in. If rates go down, I always go down to the lowest rate as possible at the time of your closing. So you have till October 26th, let's say, to find something. And if you don't, and you're still looking, I have to redo the pre-approval in terms of resetting the rate commitment. But as long as nothing's changed with income or credit, everything is still good. The pre-approval amounts are still good. It's just the rate has to change. So I have to reset those rates for another 120 days. So that's how the resale side of it works with respect to pre-approvals and the rate commitments. When it comes to builder, now in that sense, we can pre-approve now, obviously. You go and you buy the property. If you're buying a condo pre-construction, usually have a 10-day cooling off period where you come to me with the purchase agreement and everything. I've already pre-approved you based on your credit and your income. Now I have the property in hand. I'm going to submit for a firm approval. So what we do there is that once I've got the firm approval, I'm going to set up what's called a builder rate cap commitment. We've got differing rate cap commitments anywhere from 6 months, 9 months, 12 months, 2 years and 3 years, and in some cases up to 3.5 years. So what that means is that I'm going to be able to cap the rate for you for whatever we think the project's going to take to complete. So if we think it's 2 years, we're going to do a 2-year rate cap. If we think it's, just under 2 years, maybe we do an 18-month rate cap. It really depends on where we look at that project and where we think it's going to complete. So what happens there is the rate is going to be capped. It's going to be a higher rate than what is today, but it's in a situation that your rate will never go higher than this. So to give an example, let's say right now the 1-year rate cap is 3.49%. Today's rates are about 1% less than that. Today we're at about 2.49%. So what happens there is that I would cap the rate for a 1-year rate commitment of 3.49%. And in next year, when the project is almost completed, we'll look at the rates at that time. If rates, let's say, jumped and then rates became 3.99%, then you don't need to worry because I've got you at 3.49 already capped, ready to go. You wouldn't even have to look around anywhere because the rate, no one would be able to beat it because I'm down almost 0.5% lower. If the rates at that time didn't make any movement at all, and it was still 2.49 next year, of course, I'm not going to give you 3.49. I'm going to flip it into what's called retail pricing within 4 months to close, and you're going to have 2.49%. So at the end of the day, you'd have an approval, and no matter what, you're going to be protected with the lowest rate, whether it's the ceiling rate of 3.49 or whatever the current rates are. So it'll never go higher than that. So that's the protection rate we're able to offer with our RBC builder rate cap scenarios.
Awesome. Thank you. Does anybody have any questions at all for Dion at this time? If you do, throw that in the comment box and we'll make sure to get those answered. If not now, at the end, if you think of anything from the lending side. One thing I will say about RBC is that the firm approval, and that cannot change. There are things that happen in purchasers' lives all the time, especially with this pandemic, that we would not have known. People losing their jobs or whatever. Even simple as this. What if you bought a car? I had a client that went out and they got their waiting for their house to close and they ended up buying a van before their house closed. Now that throws off their ratios that they were already approved on. Any other bank would have gone back and rechecked and looked at it, and then they would have been in big trouble because their numbers would have been off and they wouldn't have been able to close their mortgage. RBC gives them a firm approval from day one because they threw off those numbers later. They didn't have to go back and check, and it didn't affect their mortgage. So there's many benefits, but that's one of them for working with Dion and RBC for sure. When we're talking about finding the right property, as first-time home buyers, one of the biggest things that I talk to people all the time about is that they think this is their forever home, that they're going to live here for 30 years and it needs the white picket fence and everything like that. Or people say all the time, oh, Kevin, I don't want to live in a condo. I want to live in a detached house, or I don't want to pay condo fees right now. Well, that's where the money numbers come in, because at the end of the day, we cannot change what you're able to afford. Dollars change in different areas for sure, depending on where you're living, working, or whatever. Some people move farther out to get a little bit bigger or more space and have a little bit more travel time to and from work or whatever they need to do, where people then will get what they need to do, stay close, or whatever their lifestyle is. So we always talk and guide, advise, consult. We get to figure out what's making sense to you. But at the end of the day, every first-time buyer has to realize that you're only going to live in that house from 4 to 7 years. That is the average. Average first-time home buyers are in and out within 5 years. But they say 4 to 7 is when everybody goes. So don't think about the white picket fence. Don't think about this being your last home. Think about getting started, building equity, whether you're paying rent today, so stop paying rent and getting to paying yourself, or getting out on your own and start building equity. It's another way to do that as well. I have clients, first-time home buyers, that are living at home. They buy pre-construction. It's not going to be ready for 2 years. They love living at home. They have it great at home. So when the place comes due, I've even had first-time home buyers not move into their first purchase. They ended up renting it out and stayed at home a little bit longer and then did something else. So if you are staying at home, it doesn't mean you still can't invest your money into real estate to start making you some money and then be ready to move out when the time comes. About the property, there's lots of different things, like I was saying, when we're talking about what we're looking at doing, but everybody's situation, their timeline, all is going to come into play as to what we're looking at doing for you. Buying power is a huge one. One thing that a lot of people like over pre-construction, over resale, is the fact that they're getting a brand new property. People really, really like that they're getting something that's never been lived in by anybody else, or that it's just brand new and everything's new, modern, and it looks great. One of the programs that is out there and is available is called Purchase Plus Improvements, which is a project we've used many, many times with our clients, and it allows people to get into if you've seen the TV show Property Brothers or whatever, where they buy the house and then they renovate it and they make it what they want, it's the same kind of concept. And Dion, maybe you can come back to this in a minute, but I'll simply glaze over this. If you're approved for $600,000 and you buy a house for $500,000 with a contractor in place and different stuff like that, that $100,000 can be released to help purchase that property and then renovate it through the proper people. You can't take that $100,000 and go buy a Porsche. It has to go into the house, and everything has to do that. But Dion, do you want to talk about that really quick?
No, for sure. I could talk to that. Yeah. So with that process, the way it works, and so how it avoids you, going out and buying a Porsche. Every lender is a bit different. With RBC, with that Builder Plus Improvements program, our cap right now is actually only 40,000. So there might be other lenders that might do 100, but for that program, I'm at 40. So what happens there is like, let's say you go buy a place for 500, and you're going to do 5% down, but you want to do things like redo the kitchen, the bathrooms, the flooring. We'll basically do everything that's included as long as it's going to add value to the home and it's attached to the home. So some things that are not included is we wouldn't include the appliances or anything that's something you could take away. So what happens in that process is that I would get you approved for the mortgage. You would then, between now and the closing, which let's say might happen in 60 days, you have a couple of visits. You would enlist a contractor, go with your visit to the property, take a look at it, get the contractor to give you some quotes. Then whatever that quote is, I'll send into my credit team. And what they'll do is they'll look at the quote and they'll say, okay, what's in, what's out, what can we do? And so typically, most things are going to be included. So let's say, new kitchen, cabinets, countertop, flooring, all that stuff, all that would be approved. And so let's say it's okay, great, you're going to spend $50K, we'll be able to approve 40 of it. We would give you that extra 40K. So what happens is when the place closes and you get the keys, we're going to advance the new mortgage with 40,000 more than what you paid. And you start paying on that. But what happens is that the actual 40,000 is going to get held back. So now you have to make sure that you have the ability to go and do the renos that you need to do, paying it on your credit card or whatever, your line of credit, whatever you need to do to get the job done. We're not going to give you that money yet until you show it's completed. So once it's all done, then you come back to me with the invoices. I send it in. And then once everything's all approved, okay, great. The 40K gets released to your lawyer. And then the lawyer will give you back your money. So that's kind of how it works in a nutshell, is that we'll give you the higher mortgage, but you have to then go do the work within a reasonable amount of time and get it done. And then we'll get you the money back. But you do need to ensure that you have the ability to pay for the renos yourself, and then we'll get you that money. But then at the end of the day, it's into the mortgage, you're paying it, it's all complete, and now you have a home that's been improved by $40,000.
Excellent. Yeah, think about it. You're going to buy an old home and you don't like the bathroom. Well, now you can get the bathroom done and you don't have to worry about it. It's a great little program. So Kay wrote in a question here. I'm just going to read it off. Basically, she's looking for advice, wanting to buy a pre-construction home. How is the approval and how is that done? So Dion, maybe we can come back to that and just let her know a little bit more about how that pre-approval is done again for the pre-construction. And then for me, what advice would I give to you for your search and the first steps of the process? Well, like I was saying, Kay, it is very individual. We definitely want to sit down and talk to you on a personal level. We can run over different scenarios. Again, what your life is at right now, where it's going to be in a couple of years, where you're living, where you're working, what projects are around us is what we'd start to talk about. We have to figure out budget first. But what I'd love to do, Kay, is I can connect with you after this and we can maybe set up a time to chat over the phone, just you and I, and then see where we go from there. But we'll get back to that. Dion, do you want to go with just going over the lending again?
So the question was, how do we qualify pre-construction?
And pre-approval, yeah. What would she need, I guess?
Yeah.
What would she need for the approval?
Yeah. So if it's a pre-construction condo, we can do a couple things. So one, before you go and make the purchase, we can look at your situation to pre-approve. So that would be looking at your income situation, your credit situation, your down payment, make sure everything is all good to go. So that would be, again, I'm vetting you, your credit, your income, and down payment. So now when you go and purchase the pre-construction, if it's a condo, let's say, as I was mentioning before, with that, you have typically 10 business days to, get everything in order, have the contract reviewed with your lawyer, get the approval process going. So you would come to me with the purchase agreement now. So what I would do at RBC is I wouldn't just pre-approve. At that point, I would look to get you an approval. So now I've already vetted you for your credit, your income, and down payment. So now what I'm going to do is submit the application for approval with the property now. And we do everything up front, as I mentioned. So we're going to do the appraisal if required. We're going to do all those things up front. And so we'll get you an approval. Now, let's just say, maybe you only have the 5% now and you're going to save to 15% for the deposit structure. Or maybe you're going to have a family member that's going to give you the other amount you need to put on deposit with the builder. That's all fine. I can get you an approval pending the rest of the down payment confirmation. So once you've saved it up and then you provide that proof to me, then I can firm up my approval. But the good news is that it's called an agreement in principle approval. And so if nothing else changes with respect to your income, your credit, like I don't have to check any of that again. All I have to do is confirm the rest of the down payment. That approval is going to be good. So now why that's important is there's other situations where, not to say in the Toronto, GTA, greater, horseshoe area is going to be an issue, but let's just say property values were to decline. When I do my appraisal up front, the value it comes in at the purchase price. I'm guaranteeing that value. I don't need to redo the appraisal either. So that's important. In the event that something were to come in under, if you went to go apply elsewhere in 2 years when the place is almost ready, and let's just say in the smallest case scenario, the values aren't coming in at what you paid, my approval would still hold at the purchase price. So you would not be in a situation where you need to come up with more down payment. So that's another important value of the firm approval up front. But these are all the things I would do ahead of time. So either we qualify you firm approval because everything is confirmed now, or it's maybe we're missing the down payment or something along those lines. Mainly, clients just haven't saved up enough and they're going to be saving up. Then that's fine. We can get the approval based on providing that later. And that's what I would do in terms of that process. So 10 days, we get that process done. You make sure you're comfortable. If you're buying a pre-construction, but it's a freehold, then with that, there's not usually any kind of cooling off period. So you have to make that purchase, know you're good to go. That's where I'll really come in to make sure you're good on the value. And so once you put that deposit down, you're committed to that purchase.
Hope that answers your question, Kay. And again, for the individual personal stuff, we can definitely chat about that at a later time for sure. She says, thanks, Dion.
Perfect.
So when we're looking for the right property, again, if it's pre-construction or if it's resale, there's differences to both. And we're going to talk about what makes the most amount of sense for you. A lot of people struggle with buying pre-construction because you're buying a plan. You're buying, I don't know if you can see over my shoulder there, there's floor plans on the wall here. That's basically what you're buying. You're buying, looking at something, a drawing, a plan, an idea. It's a concept that's coming, where when you buy resale, it's tangible. You can touch it already, walk through it. You can really get to feel your space. And some people really prefer that over buying something that they're not sure what it's going to look like when it's coming down the road, other than what they see in pictures and stuff. So it is about finding the right property for you. Dion was mentioning about condo. Again, there are differences in pre-construction versus condo and freehold, as well as resale between condo and freehold. We have conditions when we're putting together an offer. Whenever we find a property, let's call it 123 Main Street, and you guys want to put together an offer and buy it as your first home, we're going to present an offer to that seller, and there's going to be conditions in there that are there to protect you. The main ones that we'll talk about right now, because they're all different for the property, but home inspection is a big one. So that'll be in there. We're going to get a home inspector to go through there and make sure that everything's looked after and proper for you. They're going to look after mechanical, electrical, and structural issues and break it all down. Our guy provides you with a report. He uses a heat thermal gun, and anyways, he goes through the entire home, top to bottom, attic and all, with everything that you're going to need to know about what's going on with that home. So it's great. So you're going to know what you're purchasing. So having a home inspection is key. So worst come to worst, you like 123 Main Street, we do the home inspection, and it comes back with electrical issue or structural issue, or at the end of the day, you just simply change your mind. We can remove ourselves from that purchase. We're getting your deposit back 100% in full based on that condition. The second one is a financing condition. That would be where we would have you pre-approved. We're always going to get you pre-approved before we start hunting. But at the end of the day, just because we have a pre-approval, we want to make sure you have a firm approval before we remove that condition and say you're going to buy that house. So during that time, we would then go back to Dion and make sure that everything's okay. He would then give us a firm approval, a thumbs up, and we remove that condition. The other one that's major is when you're buying a condo, and it's only with a condo. It's called the status certificate review and everything like that. So with that, and I'm going to let Paul speak a little bit more about the status review and what they're looking for in the condo documents and disclosures and stuff like that. But the same thing with pre-construction. When we buy pre-construction and we sell it, we're going to have a 10-day cooling off period, like Dion mentioned, decision period, where you have to get your mortgage letter that you're going to be able to afford it. You have to review your condo documents and disclosure, having them reviewed by a lawyer to make sure they know what's going on, and that you are in 100% agreement with that purchase and sale. One thing is for sure, agreement and purchase and sale from a builder are 150% in the builder's favor. So we have to do what we need to do to make sure that you're protected at the same time. And the only way to make sure you're protected is to have everything that is important to you in writing. So whatever that may be, again, everything is different. Every property is different. And I'm not going to cover all the different things that we need to look in, but you know, it could be so many things, like a bulkhead, for example, at the bottom of a stairs, little things like that, to major things like if there's going to be a gas line or something like that that they don't tell you about and that's important to you, we got to write that stuff in. Paul, if you're around right now, I know we're stealing you. Yeah, awesome.
Yes, sir.
So, everybody, Paul Silva here with Rinaldi Silva. He's going to jump on and just talk to us a little bit about the legal side of things, the differences between a condo and freehold purchase with status certificate, and then as well our rescission and disclosure on the pre-construction. Paul, I'll let you take over. Thanks.
Thank you, Kevin. It's a pleasure to be part of your seminar today and to have been included with your team. Everybody here is very experienced, and certainly I specialize in the legal side of things. So as Kevin mentioned, there are differences between a freehold purchase versus a condominium. Things to be aware of. If you're purchasing a freehold, then you're not into issues of status certificates and monthly expenses for condominium fees. So very different animals. And certainly between new and resale, there are great differences as well. So I'm going to just briefly touch on the differences when it comes to resale, and then I'm going to turn to new home or new home purchases. So in terms of resale, if it's a freehold townhouse, for example, and there are no condominium fees, or even if it's just a fee for the roadway, that means that you're essentially responsible for maintaining your property yourself versus paying a monthly common expense that is designed to pay for the cost of grass cutting, snow clearing, salting, perhaps the replacement of the roof, the doors, the windows, etc. Obviously, if the condominium corporation is going to be paying for those expenses, then naturally they're going to collect more from you every month to make sure there's enough available when those repairs are required. And certainly high-rise buildings are always going to be condominium because they need to be managed, and everybody has to contribute their share to the cost of maintenance of the building. In terms of when you're purchasing a used condominium, we'd certainly review status certificates. We're looking for whether the vendor has been paying their condo fees or if they're in arrears. We're also looking for things like, has the corporation been sued by anybody? Maybe somebody that's walked along the sidewalk or in the lobby, fallen, broken their leg, and they're suing, or they've got a dispute with the condominium corporation due to something else. Those are things that can increase fees, and we are always, we're always looking into those kinds of things. In addition, we look for things like, did the owner of the unit make changes without the authorization of the condominium board or corporation? Those can cause problems for a new buyer, and that's something you want to avoid as much as possible. None of these issues are really relevant for a freehold because really it's not too far off from buying a home, a home that has no condominium element. But condominiums are a special animal, if you will. Oops, sorry about this. Sorry, somebody was calling. And so condominiums, we're always looking at those things. The other thing is the reserve fund study. So condominium corporations will hire engineers to come in and look over the property, and then the engineers will advise them on how much they should budget for in order to make sure there's enough money in the kitty, if you will. That's for repairs that are anticipated and also things that are unanticipated. So repairs that may be required that nobody anticipated. For example, there could be structural issues to a foundation, and the management company and the board has to decide if they're going to tackle those, when they're going to tackle them, and if they have enough money for that. And that's very important to understand sort of where their budgets are, and the reserve fund studies are designed to explain those things. Now, I was purely talking about resale, so of course there's going to be a condition when you're purchasing for us to review the status. We would get that condition waived once you're satisfied that the status is to your liking. Something as basic as the rules is also something to consider, because the rules will be included with the status certificate. So if you're purchasing a condominium and you have 2 big dogs, because you're a dog lover, and the building doesn't permit 2 dogs, it might permit 1 dog and a cat, or a certain type and size of dog. Well, you need to know, because once you buy that unit, you're stuck with those rules, and they don't change them arbitrarily for people. Okay? So those are things we always bring to your attention as well. So that's on a resale side. As far as new is concerned, we're less concerned about the status certificate, and at that point we're more concerned about the purchase contract, because as Kevin's very accurately said, those contracts are designed to favor the builder. They're designed and written by their own lawyers, and they have every out possible that they're permitted to have by law in those contracts. And they do that on purpose, because obviously they're investing a ton of money in these buildings, and they want to have maximum flexibility. Most buyers don't know the first thing about contract law. Most buyers wouldn't understand half of the things in there. So we, of course, try and summarize and explain 300 to 400 pages worth of materials into 2 or 3 pages, which is a pretty difficult task. But we do that on a regular basis because we know what we're looking for. We are very familiar with the contracts. We know the clauses to review and advise on, things like HST. For example, a purchaser of a new unit that has the intent to live in the unit will have an HST rebate incorporated into the price by the builder. If the intent is to purchase it as an investment, then the HST rebate that has been incorporated in the price that's advertised will be pulled out, which will mean the rebate will not be included in the price on closing. Therefore, you have to come up with that amount. But the good news is the government allows investors to apply for that money back. So you can get it back within 6 to 9 months of closing once you've applied. So those are things to be aware of, because most people don't realize that that rebate is only available for persons that are going to be living in the unit. And if you're not, then you don't qualify. Okay. In addition to that, we're looking for caps on closing costs, such as if they are going to charge you to hook up the gas, the hydro, the water, they're gonna charge you whatever the cost is, unless there's a cap. If they've capped it, let's say at $500 per hookup, then you know exactly what you're going to spend, and you can plan for that. Also included in that list of caps would be basically additional taxes for park levies, lot levies, etc. Because the municipality, when they approve these projects, will say, we'll approve it, but all those people that are going to be living in that 900-unit building are going to put a strain on the resources that are already available. So we're going to levy a special, we may levy a special tax per unit to each owner, because we're going to have to maybe account for building a new school or new sewer updates, etc. Those are expenses that the builder will pass on to the purchaser. And if there's no cap, you could be seeing a levy of 10, 15,000 potentially. Usually it's less, but it could go up to that. So we want to have caps put on those things so you can anticipate and budget for expenses on closing. Other than that, our purchase review, we typically go over also the disclosure, so you know sort of what to anticipate in terms of the budget, how many units there are, you know, the basic overall amenities. There's quite a bit of detail, and I think it's important for purchasers to understand what they're buying and investing into. There's usually restrictive covenants and also warnings, and sometimes people don't realize that the project they're buying in could have warning clauses in the contract that say, by the way, there's an abattoir a block away, and you will experience sounds and smells that are unpleasant. This is a case in Toronto where a condo was built and there was an abattoir down the street. Well, the abattoir was there before the condo was built. The corporation, the builder, put a warning into the contracts. The people that read it knew. The people that didn't read it didn't know, and were very shocked and surprised when they were smelling and hearing things they didn't want to hear in their home. Important things to consider when you're purchasing new. So we do go over all those things. And yes, Kevin was correct. I mean, usually you have a 10-day cooling off period when your lawyer can review. We do charge to review because there is certainly a lot of value in that original review. Lawyers that don't charge typically are going to include it in their fees later anyway, or they're really not doing the work. To summarize 300 to 400 pages of materials for free is probably going to mean you're not going to get that work if you're not paying something for it. You shouldn't be paying more though than $250 to $300 typically for a review, and that'll give you commentary on the contract, a summary, and then suggested changes to amend the contract to make it a bit more of a level playing field. That's what I do for my reviews. Most lawyers do the same. And certainly we're always happy to give a quote at the outset, a complimentary quote at no cost, obviously, before we do anything and engage in any service. And that's the case for any contract that whether you're buying resale or new or freehold or condo, we're always happy to review what you're doing with your agent if you like, and provide some guidance to you so you're making an informed decision. When you're using a realtor like Kevin, you know, you have an experienced realtor. So, you know, usually Kevin knows what he's doing on those kinds of things, but sometimes you want to get the lawyer involved. We're happy to do that.
I'm just going to touch on something that you just said there, Paul, and it's right. Your pages of an agreement of purchase and sale on a resale property are going to be somewhere around 6 to 8 pages. On a pre-construction build, the agreement of purchase and sale can be anywhere north of 150 pages. So like Paul was saying, to review that, you have to know what you're looking for, or they're just going to skim over whatever. So having a lawyer that's working for you, buying pre-construction, that has done pre-construction deals before, is very, very important. I just did a deal selling for our project here where a buyer wanted to use her own lawyer, and this lawyer was then confused about the 10-day rescission period and wanted to make sure they saw everything before it was signed. And anyway, so having a lawyer that understands pre-construction, if you're buying pre-construction, is very, very important. Same thing with an agent. I don't know how many times I have an agent bring their client in and they're just standing there. They're not helping advise them or anything anyways. So I try to take that on. Paul, if I could just get you to quickly just talk about the differences in the closing costs and disbursements maybe, and between the two as well, just to let people know what they're looking at on the end. I know you went over the capped fees, but just anything else that might come up at the end, the differences.
Yeah, I mean, a resale will, most lawyers in the Burlington area anyway, they're going to have pretty similar fees on a purchase. You know, there's going to be the fees, and then there's going to be the disbursements component, as you say. Disbursements are the expenses that we incur in doing the transaction. Much like if you take your car in for a repair, they're going to charge you a shop fee per hour for the labor, and then they're going to charge you the cost of the parts they had to pay for to do the job. So if you get your brakes done, maybe you're paying $300 in labor and $700 in parts. When we're doing a purchase transaction, our labor may be, or fees, may be $900, $1,000. We may have $600 to $700 in expenses or disbursements on a resale transaction. That would sort of be typical on a $500,000 purchase or less, for example. On a new purchase, a new build, you're going to see higher costs because typically you're going to have the review at the beginning, which is going to be like $250 to $300. And then if you decide to proceed, there's going to be two closings. There's going to be an occupancy closing, and there's going to be a final closing. Typically, an occupancy closing, most lawyers are going to charge somewhere between $250 and $300. That's the process whereby you get to move into the unit and live there, but you're paying interest on the money you owe the vendor on closing, and they call that occupancy fees. You'll pay that until the builder is ready to transfer ownership, and there's a complicated legal reason for all this stuff we won't get into, but basically there's the occupancy closing that I just mentioned, and then there's the final closing, and that's when they transfer title to you, and that's when your mortgage that Dion has set up for you through RBC is going to go on. Okay, there's additional fees and closing costs for that part of the transaction. So the difference between a resale and a new build is going to be your initial costs for agreement, review, and negotiation, your occupancy closing costs, and then on your final closing, you're going to be similar to what a resale home would be. You know, it's going to be based on your purchase price, and your disbursements are going to be dependent on the building or the property. They're always dependent. So if I'm searching a 1949 house, a bungalow in Burlington, I may spend $150 on your title search, whereas if I'm looking at a Mahadeo build in the Orchard from 2006, it might cost $60 for the search. It all depends. We never know until we do the search, but those are straight costs. Does that help answer?
It does. Thank you. Hope that helps everybody else as well. Kate, I think it's Cadian, if I'm saying that right. I hope I am, sorry. Writes in a question, and I'm just going to say the same thing. For the personal stuff that matters to you, I would love to have a conversation with you. We can dive into all that, but the general part of the question is talking about a 5% deposit in pre-construction, where before we've been talking on this about 15% being the normal deposit that you have to make until you get occupancy, and then you go through with your mortgage. What happens with builders is they have a sales cycle. At the beginning of their sales cycle, they're in their soft cost stage. They are selling units after they've bought the land, and they're trying to sell units. So until they can get construction financing by the bank, which is millions and millions of dollars at the beginning, what they have to do to prove to the bank that they're a viable project, that they should get their construction financing, is have 70% of their units sold. So let's say you have a 100-unit building, you need to have 70 units sold. Very simple. And then also 15% collected from that 70% of down payments. Once they get their construction financing and they go to sell that last 30 units, now the builder has more flexibility and can do different things, like offering less deposit, because they don't need to collect more money to get the financing. they're now able to sell that last 30 and do different things. So typically, builders will do something like that at the very end of their sales cycle. But what's happened there is prices have gone up because you're at the end of it versus the beginning. Obviously, the best time to buy pre-construction is the earliest possible time. You know, the best time to plant a tree is today, or 20 years ago, and the next best time is today, right? Same thing with pre-construction. The earlier you can buy, the better it's going to be for the amount of equity you're going to appreciate over the build process. So if you're getting an opportunity to buy with a builder at just 5% down, they're at the end of their sales cycle. The other thing that all builders do is they hold back units so that when they are completed, they can then put them on the MLS or list them and sell them publicly. Then that allows people that didn't want to buy off a plan to then come in, walk through the unit, touch it, see it. All the upgrades would have been done by the builder's choice, not the purchaser's choice, which is one of the benefits of buying pre-construction. But they would have to now be paying a premium as well. So, but again, pros and cons to everything. If that's a situation, it's the right neighborhood for you, you're going to get to move in less than 6 months. Hey, maybe that makes more sense than waiting another couple of years to do it. But Katie, I'd love to chat with you on a personal level so that we can talk about what's making sense and what's going on in your world, and then we can figure out what makes the most amount of sense for you. But and I'm going to share my screen with everybody in just a couple of minutes here. I just wanted to, because your question has also brought me to a little video that I want to share with everybody that basically talks about the difference between paying rent now and buying something later. So if you just give me a second here, Katie, and I hope that answered your question for the majority, but like I said, I will talk to you on a one-to-one later on. So I'm just going to share my screen here, folks. Bear with me and enjoy the video, and then we'll connect back after this. So here we go. I want to share a little quick story about two separate clients of mine that were both looking to purchase the same time about 5 years ago now, just over. They had very, very, very similar situations with what they were able to afford, but they went two totally different directions. So one couple purchased a condominium townhouse in Clarkson, which is West End, Mississauga, right near Clarkson Go. And got into something which was at the very max of their budget, which at that time was somewhere around 400. I don't remember the exact number, I apologize. But anyway, somewhere around 400,000. They bought to their max, got something that they knew would work for them, but didn't give them everything that they wanted. But it got them home ownership, and it got them started and got them what they wanted. So that's what they did. The second couple decided at that time not to purchase. They wanted more. They wanted to wait. They wanted to save more money, which is very hard to save as fast as everything else appreciates. It's tough to do that. But they also, the market, they couldn't catch up to the market. Things changed. Lending rules changed over the 5 years. Prices obviously increased over those 5 years. That second couple just bought a house 5 years later. But instead of buying in Mississauga, where they could have bought, they are now priced all the way out to Cambridge to get what they wanted, which again is now a townhouse with condo fees, similar to what they could have bought in Mississauga 5 years ago, but they didn't, and they made their choice. And hindsight is always 20/20. The first couple that bought, since they bought, they have resold and bought something better and made money off their purchase and done everything to benefit from their decision 5 years ago, which was to take that leap, to put all of their money they had been saving and max out as they did to push their limits. But they didn't spend all their money. Again, I'm going to use the Porsche example, right? They didn't just go blow their money on a car. They really just took their money from their bank account and put it into another bank account. At the end of the day, your house is going to make you money while it gives you a roof over your head. So it does many, many things for you other than just provide a roof and a place to call home. So again, when we're talking about your first home, it's to get you started. It's to get you in home ownership. It's to stop you paying rent and start paying yourself. Don't think about a forever home. We want to get you into something that makes sense for you today, because life is going to change in the next 3 to 5 years, and you're going to relocate or whatever happens. Something is going to change. So don't think about getting and being in your forever home. That is the conversation that I say with new buyers. We talk the longest about having everything, the 2-car garage, the white picket fence, the whatever it is that they want. They have to realize that you don't need to get everything on your first purchase. It's a stepping stone. It's getting started and moving forward progressively. There was another question that just popped up. I'm going to read that. Sorry. What is the maximum amount of mortgage banks will usually approve based on the household income?
So good question. In every situation, it is a bit different. So it's those calculations I was mentioning. But in a nutshell, if you were to assume 20% down, no debts, you take your household income. If you multiply it by about 4 to 4.5 times that number, that'll be your mortgage amount. So to put that in as an example, let's say your household income is $100,000. You can multiply that by 4, easily $400,000 mortgage, assuming no debt, 20% down. It could be a little bit more. So I'm saying 4 to 4.5 times, but that's going to be your baseline number to think about. So, someone's household income, $200,000, easily they can do an $800,000 mortgage at today's rates, possibly a little bit more. So like I'm saying, it would be between 4 and 4.5 times. But that's just like a baseline. Definitely would want to look more granular and run those numbers for you. So that's where those ratios come in that I was discussing. But take that and multiply by 4 as a starting point is a good one. And another metric to know, just in terms of where we are right now with rates, if you take a $100,000 mortgage, your payments per month on that $100,000 right now at today's rates is about, I would say if we do it over 25 years, you're looking at about $440 to $445 per month. So, $100,000 mortgage, $445, $200,000, about $900 a month. So it just gives you a sense of what those payments are going to look like for you on the mortgage as well.
Thank you. Hope that answers the question. And again, we're going to do a Q&A for anybody. I know we've been throwing them out right now, but we're getting close to the end here, so you guys can go enjoy your Saturday. I hope you guys have taken in a lot here. But just to recap, talking about the differences between resale and pre-construction, when thinking about what's going to make the most amount of sense for you, you really want to think about your current living situation and the timing, whether a year and a half or 2 years away from moving is going to make sense for you versus 60 to 90 to 120 days. The amount of cash that you have for deposits or whatever is going to make sense for your financial situation at this time to how we get started. And then obviously the current income to where we go. And the differences between purchasing your 5% minimum, like Dion was saying, on resale versus pre-construction. Most of the time at the beginning of the process, we're going to need 15%. So that is a big difference for cash on hand. The time to move in, like we're saying, and then buying a plan versus actually buying something that you can live in, walk through, touch, and see it versus that. Before we sign off here, I will connect again with all of you via email, and I'll put Dion's and Paul's email addresses in there as well for you guys if you have any questions. And we'll definitely connect with you guys again. We're here to help you buy your first home, your second home, your third home, and anything else you guys do in real estate from here moving forward. And I look forward to speaking with you guys. Thank you so much for your time. Thank you, Dion and Paul, for joining me today. I really appreciate everything. And I hope you guys got what you were looking for this afternoon, and hopefully more. But we'll definitely talk again. Thank you so much. Bye for now.
Thanks. Take care.
I'll say bye for Paul as well. Cheers, guys. Thanks so much. Oh, there he is.
Thank you for having me on the show today. I feel like a movie star. Thank you, Kevin. And
You
good
are
luck,
a star,
everybody,
that's
on your
for
new
sure.
purchase. Take care.
Awesome. Thanks, Paul.
Thanks. Bye-bye.
Bye.